Welcome back to Closing Bell. Major averages rallying into the close today with the S&P 500 roughly 2% from a 52-week high. That's all. However, our next guest is staying cautious and thinks the market's overly optimistic on the road ahead. Let's bring in Treasury Partners CIO Rich Saperstein back with me at Post 9. Well, some more things change, the more they stay the same.
I guess
that's what I think of when I see you. And we read intros like that. You're still cautious on a market that's proven, as we said at the outset, to be pretty darn resilient.
Yeah, well, at the peak of our cautiousness, we trimmed by 10%, and we kept all of our large tech holdings. And we now are back at full allocations with the market appreciation. But we're able to use that capital to redeploy into 4% tax-free muni bonds, which is an outstanding opportunity for our clients.
So you still think that opportunities outside of equities provide the best risk reward for you and your clients?
Yeah, at this time, we think there's great opportunity in the bond market, which was uninvestable for roughly 15 years. And clients that had large equity positions that built up over the years, it's time to trim them and reallocate into other alternatives.
How about this notion that Ken Griffin posed at the very top? You know, surprised somewhat, you could tell by the level of resiliency that this market has put forward, even in the face of all of these headwinds that people like you look at and say, gosh, I don't want to be overly exposed to equities, yet here we are.
Super impressed with the resiliency in the economy because of a couple of reasons. One, labor hoarding. Two, you've got the excess savings post-COVID that's being burned off by consumers. Three, you had the suppression of the student loan repayments. And a lot of that's reversing right now. So we're going to have QT added to that mix. And you've got a situation where the bite of Fed tightening still has to take place.
So, I mean, at what point do you change your view? Earnings expectations are up. If that remains the case, that earnings meet the moment and meet the expectations, and inflation, though sticky in certain areas, particularly related to services, continues to come down. What is it out there that causes somebody like you to change your view?
Okay, so right now the market's pricing in let's call it a bullish slowdown, where there's tepid slowdown in economic activity.
A soft landing.
A soft landing. Plus declining inflation, then a Fed that cuts, then next year an AI-fueled rise in the equity markets. And I just don't think the pieces are going to fall into place like that.
In which part? I mean, that all doesn't seem like so far-fetched at this point.
Well, let's look at the numbers. So the S&P generated $96 in earnings in the first two quarters. The estimate for this year is $222. So we need to have $126 in earnings in the next two quarters, 12% sequential growth. Now, I don't see that happening. Then in 24, we need another 12% to get to 248. So I think the market's pricing in excessive earnings growth relative to where they're going to come in.
Okay, so you think the market's overvalued. Is that fair?
It's hard to talk about an overvalued market because tech has had a profound impact. Specifically, a decade ago, Apple and Microsoft were roughly 5.5% of the index. Today, 13.7%. So that's driven the average multiples higher.
That's right.
So I don't really look at the multiple. I'm looking at the economic outlook. And what I really have the opportunity to do is to invest past the Fed tightening, all this nonsense about, is inflation coming down or not? There's a wide range of asset classes I could choose from, and that's what we're doing.
I know, but I sort of ask you that as I'm thinking about your allocation to, you said you didn't reduce any of your holdings in mega cap. So
no.
you have a broadly negative view of the market, but in some respects you're justifying what some would call inflated valuations of mega cap.
Okay, so mega cap has great benefits of recurring revenues, a large moat around their business, and take a look at Google. Roughly $90 billion in revenues, in operating cash flow, $30 billion a year in CapEx and R&D. That's not on the balance sheet. So for 5 years, there's over $100 billion in R&D that's been spent that we have yet to see the benefit of. So I think these stocks are still very attractive. They're the ones that we own, Apple, Microsoft, and Google, and that they're going to probably go higher over time. Now, we also are long a lot of oil stocks. We think oil is a great sector to be in right now and have been all year.
And you have no desire to increase your weightings in I mean, what weighting does tech have right now in terms of your investments?
Probably double what we should be.
Well, I don't know. You just made the most bullish case I can think of for somebody who's negative the overall market.
Well, not necessarily negative. I would say cautious.
Cautious, negative. But, I mean, you talked up muni bonds as we started out.
So I'll tell you what, if we were negative, we wouldn't have a full allocation in equities. We're cautious. We trimmed 10% at the peak of our caution. And keep in mind, for our clients, the return to the capital is more important than the return on the capital. So we get to choose where we're going. We don't have to swing at every pitch.
What do you make of what Griffin said, too, which I've been playing a bunch today because I think it's interesting, and he's not the only one talking about the possibility of real yields really, spiking higher because of where the deficit is, the amount of issuance coming on the market, too much supply than the market can bear if the buyers aren't there to soak it all up.
Yeah. Look, that's a really good point because there's two factors here as we evaluated. One is higher rates lead to a slowdown, ultimately lower interest rates. That is conflicted with the increased supply that the Treasury has to issue to fund this $1.6 trillion deficit. So that is in conflict. But in the end, we're still buying longer-term bonds. We think in the long run, the market will appreciate, the bonds will appreciate in a slowing economy.
What's the most recent stock you bought? Does something jump out to you that you can let us know?
Yeah, so we've added to Chevron, Oxy, Home Depot. We're looking at adding to Rockwell right now. So there's a lot of names we've been adding to within our existing portfolio.
So you mentioned energy, obviously, but why Depot? That's interesting to me.
Right, so that's an interesting environment where home ownership right now is kind of frozen. If you have a 3% mortgage,
you're not moving,
and so you're going to do home improvements. So we think it's an interesting space to be in right now, given the constriction in the housing market.
Interesting stuff. Enjoyed it, as always.
Likewise.
That's Rich Saperstein joining us right here. Treasury Partners. He's the Chief Investment Officer. Up next, we're tracking the biggest movers as we head into